All right, well, welcome. It looks like we have quite a few participants coming in now. So, welcome to our Pinnacle Health and Benefits webinar this afternoon. My name is Melissa Pell, and I help to lead our account management team, strategy, and operations. And we are thrilled that we have a special guest today in Mr. Roy Ramthun. I actually got to meet Roy several years ago through several of his presentations, and I have the pleasure of joining him on the HSA Advisory Council. But Roy led the U.S. Treasury Department's implementation of HSAs after they were enacted in 2003. He's been in the industry for about 30 years. He is often referred to as Mr. HSA, and that is a very fitting name. He is the founder and president of HSA Consulting Services, and he is a frequent speaker and advocate for HSA legislation and regulations, uh, helping to kind of lead the charge for us with the HSA Advisory Council. Before I turn it over to him, I am going to mention that if we have questions, please feel free. You should have a Q&A button on the bottom of your screen. So please feel free to enter your questions through that Q&A. Otherwise, everyone is on mute. And so we will, as appropriate, we may stop Roy throughout the presentation to ask those questions. Otherwise, we may hold those to the end, but we'll make sure that everyone's questions are answered. So with that, thank you. I'm going to turn off my camera and turn it over to you, Roy.
Great. Thank you, Melissa. I appreciate the opportunity to speak to all of you today. I have family that lives in Eastern Tennessee, so I feel like I'm a little bit of a part of the state. And my parents also lived in Eastern Tennessee before they passed. So anyway, I'm in the Washington, D.C. area. I've been here for a lot longer than I would expect, but I'm delighted to participate today and share some information and knowledge about health savings accounts. So the things that I want to cover today are kind of looking back at where we've come in the past 20 years with HSAs, what we've learned, and then kind of look forward as to some of the challenges and opportunities over the next 20 years. I do have my own projections for 2025 in terms of the contribution limits and the health insurance deductibles and out-of-pocket limits. And at the very end is also your chance to ask me any kind of HSA question that you've been dying to get an answer to. I will do my best to answer your questions in our session. Although if we have to take it offline, I will mention that and we'll connect after the webinar is over. So here we go. So after 20 years, we are now at a point where about 40% of people who have private health insurance in this country have access to an HSA. That's pretty amazing. You know, that's over 70 million Americans. I've always said I want it to be 100 million Americans before I retire. And I'm excited about the possibility of that happening before I do retire. And unfortunately, this data is over a year old. So hopefully our newer data will provide an even greater insight as to the growth. Looking at HSAs state by state, this is a map showing the number of HSAs in each state. So you can see that Tennessee, as of, again, 2022, had just under a million HSAs in the state. When we look at the number of people covered in each state, so that translates into about 1.8 million people in the state of Tennessee having access to an HSA. And no surprise, these numbers are driven a lot by the states with the greater population. But look around at some of your neighbors and see how you compare. And I think you're doing pretty well compared to neighboring states. But this is a very interesting graph because this looks at the penetration rate of HSAs in the private insurance market. And I told you earlier that approximately 40% of Americans with private insurance have access to an HSA. Tennessee is up right there at 50%. And so that's a much higher penetration than the average. Again, you can look at your neighboring states. And interestingly, here is where Utah and Minnesota jump to the top of the list from a penetration perspective. They don't have the same population that like a California and a Texas does. But as a percentage of their private market adoption, HSAs are right at around 3/4 of their private insured market. HSAs are still relatively new to a lot of people. And this graph from the Plan Sponsor Council survey from 2023, shows that still about 45%-ish people have had an HSA for, under 5 years. We do have a good group of folks, about 55%, that have had one for more than 5 years, and almost a quarter that have had an HSA for more than 10 years. I think it's also important to understand, despite what we hear commonly in the media and other places, that HSAs are only for the wealthy. The data suggests otherwise. And if you can see on this graph that almost 80% of Americans that have an HSA have income less than $100,000. So I believe that HSAs are solidly used by the middle class. You can see that the largest percentage group is in that income range of $60,000 to $70,000 each year. And I think that's an important message to tell clients and hopefully future customers of yours that this is not just for the wealthy, and it's not just for the healthy either. These are a very valuable tool to many Americans in terms of dealing with their out-of-pocket costs, which keep rising every year. The number of accounts have been continually growing, and you can see that growth over the last decade or so. We're over 30-some million accounts, and the assets in those accounts as of around the end of 2023 were projected to be about $120 billion in assets held in these accounts. This data should be updated any day now for year end 2023. Unfortunately, the best data that we have available right now is from the mid-year 2023 survey done by a company called Devenir. But then you look at their projections over the coming 3 years, and you can see that they're going to grow another 20% or more over the coming 3 years. Despite all of this, when you look at HSAs from an average balance perspective, we're still kind of modest. Although they've almost doubled in the last 7 years, it's still under $4,000 per account. And I believe that that's primarily because of all the new accounts that have come in the last 5 years or so. Those balances are, probably pretty low, and so they drag the average down. These balances, that was from Devenir survey. We have similar balances reported from Bank of America, as well as the Employee Benefit Research Institute. You always have to understand where is their data coming from and what is in their denominator. So like with Bank of America, that would be primarily their account owners. From the Employee Benefit Research Institute, they have a special database of employers where they're getting their information, and not surprisingly, their average balances are a little bit higher than Bank of America, but not far off from that. So when you look at how that distribution of balances goes, a lot of people, over 50%, have, less than $500, certainly less than $1,000. So I think that some people still feel like HSAs are spending accounts rather than savings accounts. That is one of our biggest challenges going forward, is to help people understand that they can be saving more in their accounts, partly by putting more money in each year and partly by not spending every dollar that they put in. HSAs are not a better FSA. So we need to work on that from an education perspective. This data is from the Employee Benefit Research Institute, and that pretty much corroborates the data from Devenir. So a lot of people with lower balances, and then a few people with high balances at the tail end. When we look at contributions made by folks in different age groups, not surprisingly, your younger individuals are contributing less to their HSAs, but they have a longer time horizon, maybe don't quite understand what HSAs are all about. For those that have, they're closing in on retirement, they are more likely to understand what HSAs mean. And so they've been hopefully understanding our recommendation that they hang on to that money and use it in their retirement, because some of the tax advantages that HSAs offer really make it worth their while to do so. So not surprisingly, older folks tend to have higher balances than younger folks. So when we're looking at average balances, this is what I like to look at as a real sign that people do understand that HSAs are savings accounts. And you can see that the older the account is, the more likely it is that their balance is higher. So if we go back almost 20 years to those who opened their accounts in 2005, you can see that those average balances are way higher than those who are just getting started or have done so recently. And so that's what we want to see about the HSA, to help us understand that these truly are savings accounts and that individuals are understanding that and using those accounts accordingly. This is a similar graph from the Employee Benefit Research Institute. Again, makes the same point. People with older accounts have much higher balances than those who are just getting started. Investing, though, is a feature of HSAs that many people do not understand. Clearly, those with health flexible spending accounts cannot invest their money. And so when I ask people, who have what they call HSAs, basically ask them two questions. What happens to the money at the end of the year? And can you invest it? And usually they'll tell me that, oh, well, the money expires, which I know clearly that's not an HSA. And they didn't even know that investing was an option. Well, it's not an option with an FSA, but it is with an HSA. And so based on this data from the Employee Benefits Research Institute, you can see how much of a difference it makes when people understand that they can invest their HSA assets. That dramatically increases their average balance when they are investing. So if you think about moving people along a continuum of saving, maximizing their contributions so that they can save even more, getting ahead of their expenses for the future, to a point where they feel like, I'm comfortable now that I have enough money to cover my deductible, and I want to start thinking about, how can I use my HSA to save for retirement? Well, many people are already doing that through their retirement plans. Why not do some of that also with your HSA? And so investing is the key in order to do that. But we're still pretty low at a percentage of people with HSAs who are actually investing. And according to the Employee Benefit Research Institute, only about 13% of HSA account owners are investing any of their assets. So we want to see this number on a percentage basis continue to rise. That's when we know that this market will be starting to mature to a point where people understand the long-term value that the HSA brings to the table with all of those tax advantages that come with it. Because most of us are going to have higher expenses in retirement. So the best way to plan for that is to use the HSA to set aside that money in order to pay those expenses in retirement on a tax-free basis. These are the adverse contributions to an HSA each year, again by age, and just like the other graph that we showed with the average balances, again, younger people not contributing it as much, although I've seen some reports that suggest that Gen Z is really actually taking on HSAs and embracing them, contributing at higher rates on a percentage basis of their salary compared to their counterparts that might be a little bit older. So that would be an encouraging thing to remember, because if you can get millennials and younger generations to understand the value of the HSA, I think you've got a friend for life. And if they get to understand these concepts at a younger age, hopefully they will maximize them before it's too late. Back looking at the Devenir study, about a third of all the dollars contributed to an HSA each year come from an employer. And that is an extremely important point, which I will underscore here briefly. About 60% is coming from employees who are making contributions through their workplace. And you can see the corresponding dollar amounts on average that come from both employers and employees. And the remaining dollars come from individuals who either are not maxing out their contributions through their employer, or they do not have an employer, such as myself, who is self-employed. We have to make our contributions separately. And so that comes from the contributions that we are making outside of payroll deduction or otherwise. But on average, you can see that in both cases, employer or self-employed or individual, it's about $2,000 a year going into HSAs each year. So when we look at contributions and participation by employers, the report from the Plan Sponsor Council of America shows, that the larger the employer, the more likely it is that they're contributing to an HSA. Now, if we could convince employers that are smaller to do the same thing, there's so many more small employers than there are large employers, this market would really take off. And so a lot of this depends on, can they afford it financially in order to make a contribution? It's not like they have to contribute every year. A lot of them, if they can get the account started and then allow the employees to make contributions to their HSA through a payroll deduction, that would be counted as employer contributions for tax purposes. And I think that could really have a huge benefit in the HSA marketplace. In general, when an employer makes a contribution, the overall contribution is higher. And so whether those be matching contributions or lump sum contributions, the fact that the employer is making a contribution tends to stimulate higher overall contributions by the employees. Clearly, when there's no employer contribution, the burden falls on the employee. And technically, yes, this graph shows that those individuals who don't have an employer contribution are contributing more out of their own salary or paycheck. But when you combine that with the employer contribution, just like you would expect on the retirement side, this is how the accounts can grow so much faster when there's that additional money put in there. And the employer contribution does seem to make a big difference. This survey by Mercer also shows that the size of that contribution by the employer also makes a difference. So if the employer does not contribute to the HSA, you do not get as high a participation from the employees. And you can see on the right side that only 22% of employees tend to choose the HSA plan when it's offered as an option to them. However, the more that the employer does contribute, the higher the participation is. So employers who take the savings that they get by switching to the HSA qualified high deductible insurance plan and reinvest that into their employees by way of contributions see a much higher take-up rate in their workforce by doing so. I alluded to the fact that some employers are reinvesting that money, and there's an annual survey done by the Kaiser Family Foundation. And this data in Chapter 8 on high deductible plans really illustrates this, how the employer and the employee are both saving money because the premiums are cheaper compared to a non-high deductible plan, more of a traditional plan. So the employer saves money. Many times they are reinvesting that by way of account contributions for their employees' HSAs. And then the employee is also saving money. They're not paying as much in premiums for their insurance. So when you combine those two amounts from the employer savings and the employee savings, you have a lot of what I like to call free money. This is money that they used to spend on health insurance premiums that they can now redirect to their HSA account. The beauty of that is they keep the money if they don't spend it. Our health insurance is really use it or lose it, just like many FSAs are. So you can pay a lot more money for insurance that you may or may not use. At the end of the day, you've paid a lot in premium, maybe not have gotten as much benefit out of it as you thought, where if you so-called refinance your health insurance with a high deductible plan paired with an HSA, you can redirect the premium savings and use that to make contributions to your account, all of which you will save at the end of the year if you haven't spent it. And more research from the Plan Sponsor Council of America showing participation rates in the HSA plan, depending on whether or not they are enrolled in the HSA option, and that option is an HSA. Not everybody does take up the HSA, even though they've enrolled in the insurance plan that makes them eligible to do so. And some can't. Some have other reasons why they're not eligible to contribute to the HSA, and so they may take a similar account like a health reimbursement account or maybe a flexible spending account. That's the best that they can do. But look how, it matters when they enroll in the HSA qualifying plan and they actually make a contribution to it. So these are important pieces of learning that we need to convince our employer community to embrace and to use to educate their employees as well, the value of the HSA. Over time, the balances have generally crept up, although during COVID, I think a lot more people took money out, which was that's what it's there for. If you need it, it's available to you. But we like to see the longer term trends of increasing account balances over time. This interesting piece in the PSCA research survey gives us insights into how employers think about the timing of their contributions. And you can see that about a quarter of employers still fully front load their contributions. So when the plan year starts, they make a dollar contribution in probably lump sum up front, and then they may or may not make any additional contributions for the rest of the year. Others do it more on a periodic basis, such as twice a year, quarterly, monthly, or even from pay period to pay period. And I think the more likely that they're doing pay period to pay period, the more likely that they are also making matching contributions. Just like with their retirement plan, you put $1 in, I'll match you $1.50 on the dollar, what have you. So it'll be interesting to go back into their research and look how these percentages are changing over time. Obviously, the biggest downside of the front end, front loaded contribution is that if I put that money in on day one and the employee leaves my employment on day two, that money belongs to the employee, and the employer can't get that money back even though the employee left. But it is important, I think, to make sure that employees' accounts get funded and get opened early on in the plan year, especially when they're moving to an HSA for the first time. Because if it's left up to the employees, there's many procrastinators out there, which is, pretty much human nature. People will wait much longer than they should, not realizing some of the benefits that they're missing out on during that time. Definitely larger employers are more likely to offer investment options to their employees in their HSAs than smaller firms. Again, this would be an area of growth that we could work with smaller employers to educate them on why offering investment options is important. It helps people grow their balances for the longer term and gives them more options for their account owners. So to me, this is a very insightful slide, seeing how well larger employers are offering investment options. If we could just bring all of those smaller employers up close to that, we would really see asset growth in HSAs, especially those that are invested, really take off. From an investment balance perspective, most people, that being, at least 50%, have a minimum balance of $1,000 or less. And then the good news is that, we're creeping up to close to 50% where there is no minimum threshold for investing, which is what I would like to see. And a little bit less than 20% have no investment threshold at all. So individuals could invest their first dollar if they want. I know that some employers think it's important for their employees to at least have enough money in their account to cover their plan deductible. And I think that's what drives a lot of these minimum investment thresholds. They don't want to hear from their employee later that, oh, well, I didn't have the money because it was all invested and they didn't want to sell their investments in order to make a withdrawal. So another area of growth and learning along the way. So that's some high-level data on where the market has come in the past 20 years. And so now I want to switch over to what's slowing growth down when we look at the future. What are the things that we hear about as to why it may not grow faster, when maybe it's even slowing down, and what could we possibly do about that. So I'm going to kind of dive into a couple areas, looking at some of the current requirements for HSAs and how those might be a barrier to growth. I definitely think there's a lot of myths out there about HSAs, and those myths hold a lot of people back, as well as I also think that there's some less than optimal practices going on, both by employers and sometimes administrators, but definitely account owners. And so, really looking at how can we make people understand the opportunity better through education and awareness, so that they can take advantage of the HSAs and everything that it has to offer. So I hear all the time from people, since, I'm dealing here in Washington with the federal law, all of the congressional bills, and the regulations that the IRS puts out. And I hear all the time that there's these crazy eligibility rules. People can't have this kind of coverage, like direct primary care or other insurance coverage that disqualifies them. Why can't we just get rid of that stuff? I hear from financial advisors that, well, HSAs would be of greater interest to us if you could actually put more money in it each year. You can put more money in an IRA. So we're going to focus on that, and 401ks, which clearly have higher contribution limits. So there are some that would like, to increase the contribution limits. Some people look at HSAs as spending accounts, and so they see the rules and they think, well, I can't use the HSA for all the things that I want to. And there was just a bill introduced in Congress this past week that would allow individuals to use their HSA funds to pay for their funeral expenses after they die. So not just for healthcare anymore, if that bill were to pass. We also have to remind people that you can't go back in time, several years before your HSA account was established, and reimburse all of those expenses. It's only on a prospective basis. And then we get little technical administrative things that people don't like, such as, if my spouse and I are both 55 and older, we're both HSA eligible, and we can both make catch-up contributions. Why can't we put those catch-up contributions in the same account? Why do we have to open a second account just so that our spouse can make their catch-up contribution? These are technical things. Not only people understand the logic behind why they were created the way they were, but I do think that they end up being barriers to potential growth. So, one of the things that the industry has been working on is to try to reduce as many of these barriers as possible, especially on the eligibility side. We agree that way too many people are disqualified from an HSA because of other coverage that they have that they cannot avoid. And that's going to happen to all of us when we turn 65 and most likely end up enrolled in Medicare. But it also happens to active duty military individuals, veterans, and others who have coverage that just because of who they are not eligible to participate in the HSA. I won't go into all of the myths that I've heard. I've listed a lot of them. Again, I believe they are just myths. These are things that people need to understand what HSAs are and are not. And I think it's incumbent upon all of us to make sure that account owners do understand these things and how HSAs are different from health FSAs and HRAs. You cannot overeducate individuals with HSAs, in my opinion. There's just way too many myths out there. And I see articles that perpetuate some of those myths, even in the media. When I see those, I do reach out to the authors and try to help them understand that what they said was not true. But unfortunately, I never hear from a lot of them. I think, HSAs also fit in this whole alphabet soup of health benefits at the employer level, and trying to cut through, what an HSA is versus FSA or HRA or my insurance, HMO or PPO. What is an HSA qualified plan? Is it a qualified HDHP? Is it an HDHP? I get it. I understand. And I think, many of us are guilty of using these acronyms to our detriment. So we need to talk a language that individuals can understand. And I understand, the minute you mention tax savings and anything related to taxes, some people are just going to tune out. April 15th is coming up. They hate taxes. They don't want to deal with that. And if you talk about HSAs too much in the tax lingo, you are going to lose some people. As far as best practices that I see at the employer level, number one, making a contribution is so important, as I've tried to illustrate through some of the slides that I've shown. A lump sum helps get the account open. So if you can do even some minimal contribution to help get the account established and funded, that will make a huge difference. But then I think, matching is where you need to go. And at some point, you really don't need to match anymore for a lot of employees. All you need to do is offer payroll deduction, and many employees will get the tax savings that is available through their cafeteria plan. The employer also benefits every time that they do that, because they're not paying the payrolls taxes, their share of the payroll taxes, every time those kinds of things go on. Looking at auto enrollment, we give people so many choices of health insurance options sometimes. Make the HSA plan the default and make them opt out. Studies have shown that you're going to get higher enrollment. When you pitch these benefits, don't start with the high deductible health plan. Nobody wants to hear the word high deductible health plan. People get up and run for the exit. They're like, that's just crappy insurance. I don't want any part of that. Talk about the HSA first. Talk about all the benefits that the HSA offers. And then here's the plan that you have to sign up for in order to participate in that HSA plan. A lot of times that HSA plan is much easier to understand, because there's a deductible. Once you meet it, then everything else is covered, or a percentage of what's covered is paid by you, 10 or 20%. That's actually a fairly simple plan to understand. But again, you cannot overeducate on HSAs. And, we need to work with those in the insurance community to help explain some of the technical concepts on the HSA qualified plan side. But again, after people get the HSA and why it's better than the health FSA. I also think it's employers to talk about HSAs throughout the year. Don't just do it once a year during the benefit enrollment season. HSAs can be used to help people plan for retirement, and most companies are talking about retirement savings throughout the year. Make sure that the HSA is part of that, and emphasize how the HSA can help people plan for their retirement. From an administrator perspective, I do think that fees have become more competitive, and overall they have come down. But some are making a lot of money still on the fees. And so I just be careful about that. I'm starting to see a few more no fee options. I'm sure they're making their money in other places. But we don't want to overly burden people with fees. I do think that it's important to offer investment options. I won't talk about what kind of options are better to offer, but the fact that you have them is going to attract a certain group of individuals who are looking for those, especially when you're educating them on how to use the HSA for retirement. As an industry, we can all work together to improve and simplify the process for transfers and rollovers. It can be much more cumbersome than it needs to be. We'd like them all to be done through trustee to trustee transfers. Remember who we're serving here are the customers of and the owners of the HSAs, who really want to put their money where they want because they are in control. They understand the ownership aspects of the HSA. I always recommend the keep it simple, stupid principle. And whatever you do, we can overcomplicate things just because that's what we like to do. So anytime we can simplify messages and our education to help people understand what HSAs are all about, that's going to help them understand and more likely take advantage of it. Just a quick reminder that April 15th is the deadline for making contributions to HSAs for 2023. Unlike people who file for extensions for filing their return, they still have to make their contributions for last year no later than April 15th. There is no extension for that. Unless you happen to reside in an area that has been declared a natural disaster because of recent storms and other weather-related events. And you may have heard that in December of last year, there were some storms and tornadoes in several counties in Tennessee, and those individuals, HSA account owners, have been given extra time to make their account contributions for last year because their tax filing deadline has been extended to June 17th. So I know that creates extra work for those who are administering those accounts, but it is a definite benefit to those account owners. And if you can help them, especially since many of them may have had horrible circumstances as a result of those storms, the better. And for the first time ever, you can see my last bullet on that list. I'm now seeing the IRS providing tax relief for people in counties around certain cities, such as San Diego and Spokane, Washington. There's been a lot of storms if you've been watching the weather across the country. So it wouldn't surprise me that we'll see more of these come, but the IRS relies on an emergency declaration by the Federal Emergency Management Agency before they grant that tax relief. So stay tuned to those announcements. There is pending legislation. I would go through it. However, I'm going to tell you this. With the way things are in politics in Washington, D.C., I'm not convinced that any of this stuff is going to pass this year. There are two bills in particular, the HR 5687 and 5688, that would make a lot of the improvements that I talked about earlier for HSAs. And so fingers crossed that those will at least pass the House of Representatives. But there's not even a guarantee of that. Also, HR 1843, a reminder that at the end of the year, the telehealth exemption for high deductible plans is due to expire. That bill would extend that permanently. And so it's important that that bill gets done at minimum. But there's very little activity going on in the Senate right now. So that makes me concerned about the likelihood of any of this legislation passing. On the regulatory front, I'm not expecting much. We do have two things that are kind of larger than life that we've been watching, such as some regulations proposed by the Department of Labor related to the so-called fiduciary rule, and a court case that overturned some rules related to cost sharing from the Department of Health and Human Services under the Affordable Care Act. So those are things that we are watching. Hard to predict exactly how they will come out, but I'm doing everything that I can here in Washington, D.C. to make sure that those outcomes are favorable to HSAs. Just 2 weeks ago, the IRS issued a reminder relating to what is a qualified medical expense. I will not read through this, but they were notified that a particular company in particular was telling people that, well, if you just reach out to us, we'll give you a doctor's letter of medical necessity that will guarantee that you can reimburse that expense from your HSA or your health FSA. And the IRS said it's not nearly that simple. So I encourage you to go read that reminder from the IRS. They had put out guidance a year ago explaining what their policy was on these certain situations. And there are about 20 situations that you can read in that guidance. I encourage you to do that and always be careful about not pushing the envelope too far. So here are my projections for the HSA contribution limits for 2025, as well as the requirements for HSA qualified plans. I have 11 of the 12 months of data needed to make these projections. So at this point, I don't think that they're going to change. However, on April 10th, I will get that final data point and I will publish them on my website. And I've given you the link as to where they're going to be. And so I think this is where we're going to end up. And I will publish that at least several weeks to a month or more from when the IRS will make that official. But since I used to work there, I know the formula, I have the data, and I've never been wrong in 20 years. So now is their chance to answer any questions that people have, be they on material that I covered or just a burning HSA question that you've had and you've never been able to get the answer to. I'd be happy to do my best to give you an answer. And so let's open it up to questions.
All right, Roy, we've got a few in the queue. And so the first one, and it'll have a little bit of a clarification, is on the Medicare front. Any chance that legislation can be changed so Medicare Part A is not backdated by 6 months for individuals retiring after the age of 65?
We are trying to get that changed, and that would actually be something that we are trying to do in legislation. And there are several bills that have been introduced to do that. If we were to do it through regulation, we would need to go and ask the Centers for Medicare and Medicaid Services to rewrite one of their operation manuals from the 1990s, which is where they created this retroactive enrollment problem. I'm sure at the time, which is clearly well before HSAs came along, they thought they were doing people a favor, making sure that they didn't miss out on their enrollment in Medicare Part A that they're fully entitled to. We get it. But now that HSAs have come along, there's reasons why people don't want that. And it's creating a lot of headaches for people who didn't know that their Medicare enrollment was retroactive up to 6 months. So there's still a lot of confusion out there about this. I'm working on it. I'll be shouting at the rooftops if we can get that changed. So I hear you. I want it fixed too, because it's going to affect me. I'm self-employed. I will not have that option.
Very good. And then a follow-up to that one is that there is a health plan administrator that's now requiring individuals that work at companies with less than 20 eligible employees to enroll in Medicare Part A and B in order to have full coverage, which is a significant disadvantage of individuals over the age of 65 continuing to work, but of course wanting to contribute to HSAs. And the question is, why wouldn't CMS change this rule specifically for small employers? So that's kind of the follow-up, if there's
Yep.
anything else you want to add.
Yeah, no, I understand. So a couple things. Again, we are trying to get that changed by Congress. I actually believe that it was Congress who made that rule, not CMS, but I don't want to debate it. The point is it's in place. I think that rule was created when um, COBRA continuation coverage was created. They made a dividing line with 20 employees. So if you're a smaller employer with under 20 employees, those individuals who turn 65 are required to enroll in Medicare Part A or Medicare Part B. They don't have the option to stay on their employer's coverage. At the time, it was considered to be burdensome to small employers. So again, we're trying to get that fixed. I'll take it whatever way it happens, either through legislation or regulatory change. But I think it's because of the COBRA law that we actually have to fix the law in order to get that changed. As you say, this would help a lot of people because it basically amounts to age discrimination. For those who are 65 or older, they can't participate in the HSA plan. They can't accept any employer contribution. They can't make their own pre-tax contributions to their HSA, but all their colleagues can, and it's not fair. So believe me, I'm taking this to the AARP because I'm pushing that age discrimination thing, which normally, they're solidly against. And so hopefully they will help us in this.
I look forward to you solving that before I get there. Fern,
Thankfully, you have a few more years than I do.
Fern, I'm going to flip it to you. I think you had a question.
Yeah, I do. So we know that there are some unionized employers or unions within employers, collectively bargained groups where like it's HSA or no way. They're really pushing hard on their employers to offer this benefit because they just realize that it's another retirement tool, if not the best retirement tool. What other trends are you seeing out there besides, unions really pushing hard on their employers? And if there really aren't, and it's just a union, unions talk to each other, especially teachers unions. Like,
Yeah,
how do
I've noticed that too, especially in the education arena. A lot of universities and school districts understand, finally, 20 years now, understanding what HSAs offer and how they can help those educators plan for their retirement, especially their healthcare expenses. Most of it boils down to that, Medicare's not going to cover everything that they thought. It's not going to cover their dental and vision and hearing. It's not going to cover most of their long-term care. It's not going to cover all their prescription drugs, and a lot of their other out-of-pocket costs. So the more that we can help people understand those issues, you need to take advantage of every opportunity to save money that you can while you have that opportunity. Because once that opportunity goes away, you're not going to get that back. So that's the predominant trend that I'm seeing out there. I would love to see some trends in the smaller employer market, which I haven't seen anybody focus any research on small employers. So I showed you a number of data points earlier in my slide presentation showing how participation is much lower when the employer size is under 100 employees. Those, to me, are barriers to future growth in this market. And we need to understand what is the source of those barriers. Is it something to do with the insurance? Is it something to do with the way the insurance benefits are communicated? And it's hard to believe that it would be with the HSA account because I know for a fact from data that I've seen that a lot of small employers don't have the healthcare flexible spending accounts. And many of them have told me that, well, it's not as easy to offer cafeteria plans because of these non-discrimination rules. So those are things I would really like to understand better as to why are they barriers and what are potential solutions to fix those things. I've talked with many colleagues of mine who used to work at the Treasury Department, and some who still work at the IRS, and say there are things that employers can take advantage of that they may not understand. And so it all depends on where they're getting their information, how accurate that information is, and do they understand it in a way that they can take advantage of. So if you all have any insights or know people that do, I am all ears. I would love to sort of crack those nuts and make sure that HSAs are as valuable to everybody that's participating, not just larger employers.
Yeah, non-discrimination rules are a lot. So I definitely understand that, that take on it. I think we have time maybe for one more question, because this one has multi-layers, but can you discuss how HSA coverage for family changes as a child ages out of family insurance coverage? Are the old charges while the child was covered still eligible for reimbursement in the future? And then also, how can, if not, what can they do as far as having their own HSA coverage?
Yeah. So the rules for HSAs are slightly different than for health FSAs and HRAs. I know that under the Affordable Care Act and in some states, you're required to cover your children up to age 26. But with the HSA, you cannot reimburse their expenses tax-free unless you claim them as a dependent. So any expense that a child of yours has incurred while they were your tax dependent will always be and remain eligible for tax-free reimbursement from the account, generally the parent's account, into the future, as long as that expense was incurred after the HSA account was established. You can't go back 10 years and pull any of those receipts out unless you had an HSA 10 years ago. So that's the main thing. Once you can no longer claim that child as a tax dependent, they may still be on your insurance. And there may be a couple years of opportunity for that child to open their own HSA and make a family-sized contribution to it. Because if they're covered under your health insurance, guess what? They have family coverage just like you and your spouse. And they're not subject to the limit that spouses share because they're not married to the parents. So there is a small window of opportunity where that individual who's still on your insurance could open an HSA in their name and contribute the family amount to their HSA. Now, it's only going to last for a couple of years because once they roll off your insurance, that big deal goes away. Hopefully, they still have an HSA plan after that, but then their contribution limit's going to drop down to self only. So definitely something to take advantage of while you can.
Yeah, absolutely. It gives them a huge leg up, especially for retirement and healthcare savings.
Yes.
I think that's all of our questions. So we want to thank you, Roy, for joining us and sharing your immense knowledge on this topic. And we thank everyone who has attended. You will get a recording of the webinar as well as a certificate for the HRCI accreditation fairly soon, so be on the lookout for that. And Roy, we really appreciate you.
My pleasure. I love talking about this stuff. So.
Yes, so do we.
That's great.
Thanks, everyone.